Hey there, and welcome to the Deep Dive, your shortcut to being well-informed, where we take a stack of sources and pull out the most important insights, all for you. Today, we're plunging into a truly fascinating piece of corporate history, Markel Group's 2009 Shareholder Letter. Now, picture this. It's 2009. The world is still reeling from the 2008 financial crisis. Most companies were just trying to keep the lights on, hunkering down, trying to survive. But Markel, they were tearing down their old house and building a new one, all while the storm raged outside. It's quite a story. This letter tells a story of not just survival, but, well, audacious transformation and strategic growth. Our mission for this deep dive is to unpack how Markel navigated that environment, what their long-term vision really meant in practice, and the bold, often counterintuitive moves they made that year.
What's truly compelling here is how this document serves as a blueprint for resilience, but not just resilience in the sense of bouncing back. It's more about bouncing forward. It's not just about the impressive numbers they managed to post, which were good, but the underlying philosophy and the deep operational shifts that allowed them to thrive when so many were just trying to stay afloat. We're going to explore what they did and maybe more importantly, why it mattered then, and why it still offers incredibly valuable lessons for anyone navigating uncertain times today.
Exactly. So if you're curious about how a company doesn't just weather a storm, but actually uses it as a catalyst for fundamental strategic advantage, you are definitely in for a treat. Let's unpack Markel's playbook. Okay, so to really understand Markel's audacious moves in 2009, we have to start with the bedrock of their entire philosophy, an almost stubborn commitment to the long term. Even back then, they talked about operating the business with a view of years and decades, as opposed to quarterly and annual comparisons. Easy to say,
Yeah.
harder to do.
Yeah, and this raises an important question for you. In a world obsessed with immediate gratification and short-term results, how do you actually maintain such a perspective? The letter makes it clear it's about more than just a mindset. It highlights their appreciation for shareholder partners who not only tolerate but actively enable this culture of long-term business excellence. It's just a rare kind of partnership where integrity, dedication, and skill are paramount, especially during periods of crisis and like significant internal change. It implies a kind of shared vision, that allows them to ignore the short-term noise.
Right. And they really hammer home that book value per share is their best proxy for value creation over those longer, more meaningful periods. And for those less familiar, book value per share is essentially the company's net assets, what it theoretically be worth if liquidated, divided by the number of outstanding shares. It's a core metric for value investors, and Markel sees it as, well, the purest measure of intrinsic worth. And when you look at their track record, it's pretty compelling. Since their 1986 public offering, they grew book value per share at a compound annual rate of, what, 21.2%?
21.2%, that's
Yeah,
right. And to put that in perspective for you, that significantly outperformed the S&P 500. The S&P grew at 9.3% over the same period.
big difference.
Huge. And they were achieving these returns despite a decade-long drought in investment markets and a multi-year softening in property and casualty insurance. That kind of consistent long-term outperformance, especially through such varied market conditions, it doesn't happen by accident. It really speaks volumes about the consistency and discipline of their strategy year in and year out.
So this rock-solid long-term philosophy sounds great on paper, but how did it actually translate into results in the immediate, incredibly difficult aftermath of the financial crisis? What happened in 2009?
Well, get this. Markel achieved an all-time high book value per share of approximately $283. That's a remarkable 27% growth from $222 per share in 2008.
27% growth in that environment.
Exactly. This was a direct result of their disciplined approach, allowing them to capitalize on opportunities others just couldn't. The letter details a 95% combined ratio on earned premiums of $1.8 billion for their underwriting operations. And for those unfamiliar, a combined ratio below 100% means an insurer is making money purely from their underwriting, collecting more in premiums than they're paying out in claims and expenses. A 95% is a very healthy profit margin, especially for such a tumultuous year.
Right, and it wasn't just the insurance side, was it? The investments did okay too.
They did better than okay. On the investment front, they saw a total portfolio return of 13.2%. Equities were up 25.7%, and fixed income returns were 9.8%. This is a meaningful rebound after what they call the cataclysmic events of 2008.
Okay, but here's the catch. The insurance market itself was tough. You mentioned that. Gross premium volume actually declined 14%. Lower prices, slower economy, government actions keeping capacity high. So while their book value soared,
What was the underlying reality for their core insurance business, and what did Markel do in response to these difficult market conditions?
Precisely. This highlights their strategic agility. They didn't just sit there, they outlined 4 key actions for you. First, they quickened the pace of their One Markel reorganization, basically streamlining their internal structure. We'll talk more about that. Second, they actively supported the growth of their international operations, sensing greater opportunities abroad.
Makes sense.
Third, they increased emphasis on new product development to find new avenues for growth. And fourth, they made strategic acquisitions like Elliott Special Risks in Canada and other smaller niche lines. Shows they weren't afraid to deploy capital even during a downturn, right?
Definitely not afraid. Now, this next detail is a real head-scratcher in the best possible way. Their investments. In their investment comments, they noted that despite increasing their holdings during the year, their exposure to publicly traded equities remained lower than historical averages. Only 17% of the portfolio.
Yeah, isn't that interesting?
Very. They remained incredibly conservative and liquid, essentially holding a significant cash pile, ready to accelerate equity investing when insurance market pricing firmed up. Why?
This perfectly illustrates their disciplined approach to balance sheet protection and optionality. They emphasize that great pricing opportunities mean absolutely nothing if we don't have the balance sheet and appropriate liquidity and cash flows to take advantage of them.
Okay, so protect the downside first.
Exactly. They explicitly state they will always err on the side of conservatism to ensure they can act in the long-term best interests of the company. This was a direct lesson from watching many, blue-chip financial institutions either get wiped out or saved by government intervention just the year before. They weren't just hunkering down, they were setting the stage to pounce when opportunities arose, a move very few companies could make in that climate.
So to achieve those impressive results and prepare for future growth, Markel didn't just sit still. They underwent massive internal changes. 2 big initiatives stand out: One Markel and the Atlas Project. Let's unpack One Markel first. What was that about?
Okay, One Markel. It was a fundamental restructuring of their excess and surplus company. And for those who might not know, an excess and surplus, or E&S company, is like the specialty ops unit of insurance. They cover unique, hard-to-place risks that standard insurers won't touch.
Right, the tricky stuff.
The tricky stuff. Think bespoke coverage for a niche manufacturer, a high liability event, unusual property types. The goal of One Markel was simple: make Markel easier to do business with and offer more products to more customers through their wholesale partners. This meant empowering their 5 regional offices to offer the entire line of Markel products. Regional offices became primarily responsible for underwriting, marketing, sales, and customer service for all E&S offerings.
So it sounds like One Markel was basically an attempt to break down internal silos, ones that had emerged from their history of acquisitions. They mentioned problems like difficulties in cross-selling and even inadvertent competition between their own business units.
Precisely. You got it. They were trying to create a unified customer experience, moving away from a fragmented structure where different acquired units might operate almost as independent entities. The new model meant each regional underwriter had sales and underwriting responsibility for all wholesale products. This represented an enormous change to their previous way of doing business, a complete rethink of their workflow.
Huge change.
But the transition went remarkably well. They moved to the new model in all 5 regions in March 2009, an astounding 9 months ahead of schedule.
9 months ahead, during the crisis.
Yep. Even after running a successful prototype in their Mid-South region, achieving that during a global recession isn't just testament to good planning. It speaks volumes about the drive and adaptability of the people involved.
Wow. Okay, and to really make One Markel hum, they needed an equally ambitious tech overhaul happening behind the scenes. This was the Atlas Project. Can you tell us what this Herculean effort entailed? It sounds like the kind of project that would give IT departments nightmares, especially back in 2009.
Oh, it was indeed a mammoth undertaking. Atlas is their name for a comprehensive systems and business process transformation. Like One Markel, its goal was straightforward: deliver the information systems and business processes needed to smoothly and seamlessly serve customers and manage insurance operations. This included unified systems for everything: underwriting, policy issuance, claims, billing, agency management, reinsurance, plus a centralized shared services capacity.
So basically untangling decades of digital spaghetti and building a robust new platform from the ground up.
That's a good way to put it.
And the costs were substantial, weren't they?
Absolutely. The letter calls it the most mammoth business systems and process project we have ever undertaken at Markel. Now, They anticipated vendor costs around $140 million and total costs of about $190 million. That was actually up from earlier estimates as they got a better handle on the scope.
Not cheap.
Not at all. But by the end of 2009, they had only spent about one-third of the total estimated cost. The project was expected to be largely complete by the end of 2012 for their excess and surplus lines operations. The early signs of success were already visible, though. Simpler, more efficient workflows, better data. This was a long-term investment in their operational backbone, made even as the economic ground felt really shaky.
Beyond these internal overhauls, Markel was also strategically expanding externally. Let's look at Markel International first. They had a stellar 2009, didn't they?
They absolutely did. Markel International produced a 91% combined ratio and $52 million in underwriting profits. Very strong performance. They had actually been profitable in 2 of the last 3 years, only missing in 2008 because of hurricane losses. This division, which they acquired back in 2000, had already undergone its own major reorganization and modernization efforts, similar to what the U.S. operations were now doing.
So they had a template.
It shows they apply these principles consistently, yeah.
And it was a significant part of the business, too. $641 million in gross premium volume, or 34% of Markel's total. Big chunk. They were also expanding geographically, acquiring Elliott Special Risks in Canada, a premier specialty insurance underwriter, and mentioning further opportunities in markets like India, China, Southeast Asia.
This perfectly illustrates their strategy. When the U.S. domestic market was soft and pricing was depressed, they simply, packed their bags and found better opportunities abroad, particularly in regions with more rational pricing and greater growth opportunities. And being part of the Lloyd's market through Syndicate 3000 also provided crucial regulatory and licensing advantages for their international expansion, making it easier to operate across borders.
Okay, Markel also highlighted its specialty admitted insurance division. That sounded like it covered a really interesting, diverse array of niche markets.
Indeed. This division, which produced a 99% combined ratio in 2009, so still profitable but tighter margins, provides insurance directly to consumers and retail customers. And the areas are truly unique. Children's summer camps, equine risks, motorcycles and boats, pet health, wedding insurance, even political campaign coverage and excess flood insurance.
Oh, wow, that's a portfolio.
Right. They boast a higher ratio of renewals and industry leadership in many of these niche products. It's not just a grab bag of oddities. It provides a solid foundation and platform for growth by specializing in areas where they can be market leaders and command better pricing. It actually makes them more resilient, by spreading risk and finding profitable underserved segments.
Makes sense. And then there's Markel Ventures, their non-insurance subsidiaries. This seems like a distinct and incredibly important part of their long-term strategy, almost an enigma for an insurance company.
This is a crucial and often overlooked area for an insurance company like Markel. In 2009, they expanded Markel Ventures with the acquisitions of Panel Specialists, Inc. They make laminated furniture for colleges and hospitals, and Ellicott Dredge Enterprises, a company that manufactures dredges, with this fascinating history going back to building the Panama Canal in 1907.
Dredges and furniture, okay.
Yeah, these joined existing holdings like AMF Bakery Systems and Parkland Ventures, a real mix.
So why? Why are these non-insurance businesses so important to an insurance company like Markel? How do these seemingly unrelated assets actually help them?
Okay, this is where their true strategic chess game becomes visible. It's pretty clever. The letter explains that these businesses are profitable, they have good returns on capital, they're run by talented and ethical management, and crucially, they were acquired at fair prices. So they provide excellent profits. They allow Markel to reinvest capital as a majority owner, which is a very different position than just being a minority shareholder in public companies.
Yeah.
And most critically, they provide earnings and cash flow distinct and separate from our insurance holdings.
Ah, distinct and separate. Okay, I see where this is going.
Exactly.
Now, this insight is truly powerful and goes back to their balance sheet protection, right?
Mm-hmm.
They explicitly state that during times when Markel stock is selling for low valuations, financial markets and regulators are often skeptical of companies repurchasing their own shares. It limits their options.
Mm-hmm.
But with non-insurance businesses, they have cash flows independent of insurance operations, giving them more of an option for us to deploy capital aggressively during inevitable stretches of difficult times.
Bingo. That's the unique advantage. It's optionality that very few traditional insurers possess. It speaks directly to that long-term flexibility they value so much.
All these changes, the financial performance, the aggressive internal restructuring, the external expansion, None of this happens without strong leadership and a team willing to adapt. Markel's letter really emphasizes the importance of management development and the spirit of their people.
They articulate an ambitious goal for Markel to be immortal, which, okay, is a bold statement.
Yeah, just a bit.
But they argue that requires a continuously refreshed and renewed management team. In 2009, they aggressively strengthened their management ranks. Lots of individuals taking on new roles and responsibilities, like Mike Crowley heading specialty insurance operations, Britt Glisson leading that massive Atlas project, new leaders for Markel International and various product line groups. It wasn't just about hiring from outside. It was about elevating and empowering existing talent, too.
And they even brought new perspectives onto their board of directors, right? Like Deborah Wilson, who oversaw the successful development of the Weather Channel. That's interesting. And they welcomed back former CFO Daryl Martin. Shows a real commitment to dynamic governance.
Absolutely. And what's fascinating here is their acknowledgement that change often invokes fear of the unknown. They didn't shy away from that. But they countered this by stating simply, the world spins and things change. Very pragmatic.
Sure enough.
They were incredibly proud of how their people responded with willingness and sense of challenge and adventure. They felt this fostered an optimistic outlook for the organization to continue to respond, adapt, and grow. Even amidst this narrative of progress, they took a moment to acknowledge a sad note, the passing of longtime board member Legrandis, underscoring the human element of their long-term journey.
So it really boils down to that powerful statement they made. The world is not going to change to accommodate us, so we change to accommodate it. They believe they emerged from 2009 faster, leaner, and smarter, with a healthy mix of veterans and younger managers ready for whatever came next.
Yeah. And if we connect this to the bigger picture for you, this 2009 letter is just a profound case study in strategic agility and that long-term vision. It shows how a company can use a period of widespread crisis not as a reason to simply retrench, which is what most did,
Right.
but as a unique opportunity to fundamentally transform and diversify. By protecting its balance sheet, reorganizing its core operations, and building out those non-insurance assets, Markel positioned itself for future growth with incredible optionality, all while others were paralyzed by fear.
What stands out to me is how their unique advantage, that long-term thinking, combined with bold internal changes like One Markel and Atlas, plus the strategic build-out of Markel Ventures. It allowed them to not only rebound, but fundamentally strengthen their position. It's a real testament to the idea that true competitive advantage often lies in the audacious decisions you make when everyone else is panicking and just focused on mere survival. So what does this all mean for you listening? Well, it might just be a powerful reminder that in any challenging environment, whether it's personal or professional, an unwavering commitment to your core values, a willingness to adapt dramatically, and a focus on the long game, even when it's uncomfortable, can be your most powerful assets. It's about building for the future, while everyone else is just trying to live for today, maybe.
That's a great way to put it. And something fascinating to consider for your own journey is this. How might adopting Markel's decades, not quarters mindset transform your approach to the challenges and opportunities you face right now? How could you maybe weaponize your conservatism like they did to create future optionality for yourself?
Interesting question. Think about it. And thank you for joining us on this deep dive into Markel's audacious 2009 journey. We hope you walked away with some surprising facts and truly valuable insights. Until next time, keep digging for knowledge.